Howdy, everybody. Welcome to Liberty Call. Today is Wednesday, November 22nd, 2023. Hope everybody's having a great day out there. It is a beautiful day here in Colorado. The sun is out. It is a balmy, what's the temperature? 56 degrees out there. And but we're going to get hammered with some snow, I think, starting tomorrow night. And Friday is going to snow all day. And here comes my boy Jake. He's excited about the Liberty Call also, because that means once this is done, we get to go outside and play some ball time, which is his favorite thing to do. But hope everyone's gearing up for Thanksgiving. Got lots of basketball and football and all sorts of good stuff to watch. And just found out yesterday the NBA is doing some sort of in-season tournament. I was like, what the hell is this? So I don't really follow professional basketball much anymore, just because they went woke a few years ago, and it just drives me nuts. But college basketball, I love these tournaments right now at Thanksgiving and Christmas. Some of the best. Anyways, all right. Well, I'm glad you're here. If you could do me a favor, yes, you in the yellow shirt, could you give me some thumbs up, likes, shares, subscribes, follows, and press the notification bell because you want to know when I go live. All right. Today we're going to get into the markets and how Americans are struggling, and then we're going to spend a good part of time on the Fed minutes, which came out yesterday. All right, let's start out with the markets for today. The Dow Jones was up 0.53%, 184 points, closed at 35,273. S&P 500 was up 0.38%, closed at 4555. NASDAQ up 0.46%, closed at 14,265. The VIX was down 3.3% today. It's down to 1291. Canada up 0.02, flat. Brazil up 0.1%, and Mexico up 0.31. In Europe, Germany was up 0.36, the UK down 0.17, while France was up 0.43. Netherlands up 0.2, Spain up 0.61, Italy up 0.01, Switzerland up 0.47, and Portugal down 0.06. Russian exchanges were mixed today. MOEX up 0.38, RTSI down 0.21. And the Asian markets, the Nikkei in Japan was up 0.24%. Australia was down 0.07, New Zealand down 0.04. In China, the Shanghai was down 0.79, the Shenzhen Component down 1.42, the China A50 down 0.86, DJ Shanghai down 0.73, Hang Seng up 0.1%, and the Taiwan weighted was down 0.61. All right, so it's gonna be a light week. I mean, today I was just like watching the. Oh, I don't have a watch on today, but sitting here looking at the times, like, God, the day is dragging. Just want it to be over with. I mean, it's like the markets are slow. I mean, there's not a whole lot of news. So, I mean, yeah, there was a whole explosion at the border in Niagara Falls, New York, but financial news, it's been kind of boring today. All right, let's go ahead and get over to the market recap. U.S. stocks rises, tech sidesteps, Nvidia's slip. All right, on Wednesday, U.S. stocks exhibited positive momentum despite a setback in chip makers Nvidia's stock following a cautious outlook on China. Tech stocks, including Google, Microsoft, and Meta, collectively rose more than 1%, countering the more than 2% decline in Nvidia. Although Nvidia reported Q3 results and guidance exceeding Wall Street expectations, concerns arose about a significant decline in sales in China, constituting up to a fifth of its high-margin data center business due to U.S. export restrictions on AI chips to China. In other developments, Sam Altman is set to return to the leadership of OpenAI shortly after being ousted as the chief executive of the prominent generative artificial intelligence group. And actually this morning, Scott Adams made a really good point. He's like, Sam Altman is making alternative humans, or I guess maybe alternative human thought or thinking. It's kind of weird there. Is that the simulation talking to us? That Sam Altman is really just a creation of the simulation to create artificial intelligence? Who knows? Anyways, back into it. Deere & Company, the world's largest farm equipment manufacturer, faced a nearly 3% decline in its stock after forecasting 2024 profit below expectations. The downbeat fiscal 2024 guidance projecting a drop in net income to a range of $7.75 billion to $8.25 billion from the $10.16 billion in 2023. So, what is that, about 30% drop? 20 to 30% is what they're expecting. Offset quarterly results that exceeded both the top and bottom line expectations. Nordstrom also presented a cautious outlook, citing a softening consumer spend, and that's in quotes, and reported third quarter revenue below analyst estimates, leading to a more than 5% drop in its shares. Energy stocks experienced downward pressure as oil prices fell due to the postponement of the OPEC Plus meeting to November 30th from November 26th. The delay stemmed from challenges in reaching an agreement on production levels, creating uncertainty about potential output cuts. Oil prices were additionally affected by the larger than expected draw in weekly crude inventories. EOG Resources Inc., Baker Hughes, and Occidental Petroleum were among the significant decliners, with their stocks falling more than 1%. All right. So that's everything in the market recap. Let's dive a little deeper into how Americans are doing financially. Americans increasingly tapping into their retirement accounts to make ends meet. And this was via Shift Gold. All right, let's get into the notes here. All right, the resilience of American consumers is being tested as they resort to unconventional measures to cope with rising costs of living. A significant number of individuals are delving into their retirement savings to cover housing and medical bills amid growing financial pressures. Data from Fidelity Investments reveals that approximately 2.3% of workers took hardship withdrawals from their retirement accounts in the last quarter, marking an increase from 1.8% the previous year. The primary reasons cited for the uptick were desire to avoid foreclosure or eviction and to address medical expenses. Concurrently, 2.8% of 401k retirement account participants opted to take a loan against their accounts in Q3, with about 1 in 6 workers currently having an outstanding loan. The average balance in 401k accounts declined by 4% to $107,700 in Q3. This comes after Americans depleted their savings, which peaked at $2.1 trillion in August of 21, but dwindled to an estimated $190 billion by June of this year, according to the San Francisco Fed. Credit card balances also surged by 4.7% to a record $1.08 trillion in Q3, reflecting a year-on-year increase of $154 billion, the largest since 1999. This trend underscores the financial strain on Americans who, faced with soaring prices, have resorted to exhausting their savings, accumulating credit card debt, and now tapping into their retirement funds. The precarious financial situation of many underscores the challenges posed by inflation and rising costs of living, with 8 out of 10 workers expressing stress in a Fidelity survey. While some may view sustained consumer spending as an economic indicator, these unconventional measures, unconventional, hard for me to say today, financial maneuvers highlight the underlying desperation and financial hardship experienced by a significant portion of the population. So that is not good news that people are dipping into their retirement accounts to cover, day-to-day unexpected. That's why you should have a cash reserve, people. I know I preach this stuff all the time. Good financial planning avoids a lot of these problems. Understanding where your money goes, your ins and outs, having a cash reserve, protecting yourself, whether or not your life or your income or your possessions. Planning ahead. I want to retire in the future with this amount of money. These are all things that we go through. So, whether or not people want to go through that process and be financially sound, it's not my problem. All I can do is help the ones who want to drink the water. All right, last up is the Fed Open Market Committee meeting minutes. We're going to go through a pretty big deep dive on this, so it's going to take a few minutes. So if you want to save this for after you eat your turkey tomorrow and you need some help falling asleep, this will probably do it. So, all right, so starting out with the developments in financial markets and open market operations. During the reviewed intermeeting period, the manager focused on tightening financial conditions influenced by higher yields on Treasury securities, lower equity prices, and a stronger dollar, primarily driven by increased interest rates. Despite robust earnings expectations, the impact on equity prices was attributed to valuations reacting to the higher rates. Yields on longer-dated Treasury securities rose since July, mainly due to increase in real yields, with inflation compensation experiencing minor upticks. Let's see here. The 10-year nominal Treasury yield surged since July and was primarily associated with higher term premium. According to staff analysis and market surveys, the manager highlighted stable inflation expectations and unchanged liquidity conditions in the Treasury market. Expectations for monetary policy suggested market participants anticipated the federal funds rate nearing its peak until at least the June 2024 FOMC meeting. The balance sheet runoff was proceeding smoothly, and the overnight reverse repo agreement facility usage declined as reserves expanded. The standing repo facility was noted as a potential liquidity source for banks. The committee they all agreed to ratify the domestic transactions with no foreign currency interventions during the intermeeting period. Staff review of the economic situation. The October 31st, November 1st meeting analysis revealed a robust expansion of U.S. real domestic product or gross domestic product in the third quarter, supported by strong job gains and low unemployment. Despite labor market imbalances easing, the unemployment rate held steady at 3.8%, with notable shifts in rates for African Americans and Hispanics. Consumer price inflation, while remaining elevated, exhibited signs of slowing, with the price index for total personal consumption expenditures, the PCE, up 3.4% over the 12 months ending in September. Foreign economic growth, particularly in Europe, faced challenges due to monetary policy restraint, leading to a small decline in Euro area GDP. Chinese GDP improved, driven by increased industrial production, but retail sales were hindered by slow consumer confidence and weaknesses in the residential property sector. Inflation abroad remained high, prompting major foreign central banks to maintain restrictive policy rates to align with target rates. The overall outlook highlighted the resilient U.S. economy amid global economic complexities. Staff review of the financial situation. Over the intermeeting period, long-term Treasury yields increased notably, driven mainly by higher term premiums amid stronger than expected economic data. Shorter-term yields remained stable, and the market implied path for federal funds rate through the 2024 slightly decreased. Equity prices declined, particularly in interest rate sensitive sectors like real estate and utilities. Financing conditions tightened, leading to rising borrowing costs. Foreign asset prices were influenced by the surge in longer term U.S. Treasury yields, impacting sovereign bond yields, equity prices, and widening credit spreads globally. Stable short term funding markets were observed, with a decline in the usage of the on-RRP facility. That's the reverse repo. Banks reported stable total deposit levels, but wholesale borrowing by large banks increased. In domestic credit markets, borrowing costs for businesses, households, and municipalities rose due to increased longer-term Treasury yields. The October Senior Loan Officer Opinion Survey indicated tightening standards on C&I loans, weakening demand, and ongoing tightness in the commercial real estate loan standards. Credit remained available, but showed signs of tightening in residential mortgages and consumer loans. The credit quality of various sectors deteriorated with rising delinquency rates. The staff assessment highlighted notable financial vulnerabilities, citing high asset valuations, particularly in equities, housing, and CRE. Leveraging in the financial sector, including hedge fund leverage, was deemed notable, and notable means that they're paying attention to it. And funding risks were identified, emphasizing reliance on uninsured deposits and increased short-term non-deposit funding. Overall, the financial system's vulnerabilities were noted, warranting attention. And up next, staff economic outlook. The economic forecast presented at the October-November meeting closely resembled the September projection, anticipating a marked slowdown in the fourth quarter GDP growth from the third quarter rate. Despite uncertainties surrounding the auto workers' strike impact, the staff predicted a temporary restraint on output in the fourth quarter, followed by a boost in the first quarter as lost production was recovered. Monetary policy lag effects were expected to moderately constrain real GDP growth over the next 2 years, gradually aligning with potential in 2026. The unemployment rate was projected to remain relatively stable through 2026, balancing below potential output growth with improvements in labor market functioning. Total PCE price inflation was anticipated to reach around 3% by year end, with core PCE inflation at approximately 3.5%. Inflation was expected to ease in the following years. That's plural, as market dynamics improved, reaching close to the 2% for both total and core PCE inflation by 2026. This is not an overnight thing. I mean, all this rate stuff that they've been doing the last year-ish, all of this, I mean, is going to take time to squish that inflation down. Because again, like I've said this before, rates were kept at zero for the better part of a decade. And so is the inflation we're experiencing now from, say, 2009 to 2019, or is it from all that expansion in the money supply in 2020 and 2021? I don't know. All right. Where were we? 2026. The staff acknowledged elevated uncertainty with upside risks to inflation due to potential persistence or adverse supply shocks. Downside risks to the real activity forecast were recognized, particularly considering the potential need for additional monetary policy tightening and the associated risk of a more significant tightening in financial conditions. I think this is the last section here. Yep. All right. Staff economic outlook. Where was I? Where'd I go? Oh, no, I got one more after this. Participant views on current conditions and the economic outlook. During the October-November meeting, participants acknowledged an unexpectedly strong expansion of real GDP in the third quarter, primarily propelled by a surge in consumer spending. Despite the robust economic performance, participants expressed a belief that aggregate demand and aggregate supply were gradually finding a better balance. The current stance of monetary policy, characterized as restrictive, was seen as exerting downward pressure on economic activity and inflation. Additionally, participants highlighted a significant softening of financial conditions in recent months, primarily driven by notable increases in longer-term Treasury yields. The labor market, while still tight, was perceived to have eased somewhat since earlier in the year. The shift was attributed in part to recent increases in labor supply, including a rise in the labor force participation rate for prime age workers, particularly women, and positive contributions from immigration. Participants acknowledged the moderation of inflation since the middle of the year, but underscored that inflation rates remained unacceptably high, well above the committee's long-run goal of 2%. Concerns were raised about the potential adverse impacts of the cumulative policy tightening and tighter financial conditions on households and businesses. Some participants noted that certain households, particularly those in low and moderate income categories, were facing increasing financial pressure due to high prices for essentials and tight credit conditions. Delinquencies on auto loans and credit cards were also reported to have risen for these households. Despite a generally positive assessment of consumer spending, some participants cautioned that their district contacts painted a somewhat weaker picture of consumer demand than indicated by the aggregate data. The overall discussion reflected a cautious and balanced approach, with participants noting that uncertainty surrounding the economic outlook. While the upside risks to the economic activity included the possibility that factors supporting resilient spending might persist, downward risks were identified, including the potential larger than expected effects of policy tightening and tighter financial conditions on households and businesses. Participants emphasized the importance of continued monitoring and clear communications in the face of evolving economic conditions, underscoring a commitment to the data-dependent approach to policy decisions. And last step, community policy actions. During the monetary policy discussion at the meeting, members of the committee now acknowledged a strong expansion of economic activity in the third quarter, marked by robust job gains and a low unemployment rate. However, they noted a moderation in job gains since earlier in the year. Inflation remained elevated, and members expressed concerns about the potential impact of tighter financial and credit conditions on economic activity, hiring, and inflation. While emphasizing their commitment to returning to inflation to the 2% objective, the committee decided to maintain the target range for the federal funds rate at 5.25% to 5.5%. They agreed to continue assessing additional information and its implications for monetary policy, taking into account the cumulative and tightening of monetary policy, lags in its effects in economic developments. The committee also remained highly attentive to inflation risks and committed to reducing the Federal Reserve's holdings of Treasury securities and agency debt and mortgage-backed securities. The statement released after the meeting highlighted the committee's objective to achieve maximum employment and 2% inflation over the longer run. They acknowledged that the soundness of the U.S. banking system, but recognized the uncertainty surrounding the effects of tighter financial and credit conditions. The committee pledged to adjust the stance of monetary policy as appropriate based on incoming information and risks that could impede the attainment of their goals, indicating a data-dependent approach to policy decisions. The accompanying policy directive outlined the specific actions to be taken by the Federal Reserve Bank of New York, including maintaining the federal funds rate in the target range and conducting open market operations and repurchase agreement operations. Whew, that was a lot. That was a lot of information just to say that, there's problems with the economy and delinquencies are up and, cars getting repossessed are up and, people are dipping into their money. But hey, everything's all right. We're working on getting to that 2% target. Woohoo! again, this being a pseudo government entity just explains the amount of word salad that I had. And this was a summary that I did. This is not the actual text. If I read the actual text, it'd probably take like a half hour to go through this thing. So, I mean, it's ridiculous. Anyways, all right. So rates stayed the same, and the next meeting is December 12th and 13th. So that's 3 weeks away. So it's kind of up in the air. Will they raise rates? Probably not, just because everything's kind of feeling okay right now. Now, I mean, if we get some hotter numbers, from the from the jobs data or inflation or spending, again, that may change the course in the next couple of weeks, but we'll see what happens. All right. Well, that's everything I had for today. If anyone needs anything from me, please go to dsafinancialgroup.com. All my contact information is there. I hope you have a wonderful Turkey Day. I will not be broadcasting tomorrow because there's no markets open. But I'll be back on Friday to cover any news that occurs over the next 48 hours and Friday's markets. And I hope everyone has a wonderful evening. And I shall talk to you guys next time. Adios.